I want you to imagine Susan. She's 67. She just filed her taxes for the first time since this new law passed. And for the first time in years, she's smiling at her tax return. $6,000, that's what the new senior deduction just knocked off her taxable income. She does the math in her head. Lower taxable income, lower tax bill. And she thinks, finally, maybe this also means her Medicare premium drops too. It doesn't. And if you've watched my last two videos on this deduction, you might be thinking the exact same thing Susan is thinking right now. So today I'm going to show you exactly why that assumption is wrong, where the mistake actually happens, and more importantly, what you can actually do about your Medicare premium if you're worried about it. Because the goal here isn't just to correct a mistake, it's to make sure you're not planning your retirement around a number that was never going to move in the first place. Quick disclaimer before we go further. I'm not a financial advisor, a tax professional, or an attorney, and nothing in this video is personalized financial, tax, or legal advice. This is for educational purposes only. Tax law changes, IRMAA thresholds change every year, and your situation is unique. So before you make any decisions based on what I'm about to show you, talk to a CPA or a fee-only financial advisor who can look at your actual numbers. Okay, let's get into it. Let's start with what this deduction actually is, because you need to understand it clearly before you can understand why it doesn't do what people think it does. Back in July of 2025, a new tax law was signed that created what's now being called the senior bonus deduction. It's part of a bigger tax package, but this one piece is aimed squarely at people 65 and older. Here's how it works. If you're 65 or older by the end of the year, and you have a valid Social Security number, you can claim an extra deduction of up to $6,000. If you're married, and both spouses are 65 or older, that's up to $12,000 combined. This is on top of your regular standard deduction. On top of the extra deduction people over 65 already got before this law existed. It applies whether you take the standard deduction or itemize, which is unusual. Most tax breaks force you to pick one lane. This one doesn't. But it's not unlimited, and it's not for everyone at every income level. There's a phase out. If you're single, the full $6,000 is available if your income is at or below $75,000. Above that, it starts shrinking, 6 cents less for every dollar you earn over that line, until it disappears completely around $175,000. If you're married filing jointly, that starting line is $150,000 combined, and the deduction fully phases out around $250,000. And here's the part that matters for our story today. This isn't permanent. It's scheduled to run from the 2025 tax year through the 2028 tax year, unless Congress decides to extend it. So for Susan, and for millions of people like her, this is real money on the table right now for a limited window of years. Now here's Susan's actual situation so you can follow the math with me. In 2025, her adjusted gross income, her AGI, is $90,000. That includes some IRA withdrawals she took, plus some interest income from savings. She's single, she's over 65, and $90,000 puts her comfortably under that 75. Wait, actually $90,000 is above the $75,000 phase-out line for a single filer. So Susan doesn't get the full $6,000. Let's walk through what she actually gets, because this is where a lot of people get tripped up before we even reach the Medicare question. Her income is $15,000 over the $75,000 threshold. 6% of $15,000 is $900. So her $6,000 deduction gets reduced by $900, leaving her with a deduction of $5,100. Still real money. Still lowers her taxable income by over $5,000. Still puts real cash back in her pocket when she files. That part of the story is genuinely good news. I don't want to take that away from her, or from you if you're in a similar spot. This deduction is real, it's meaningful, and for a lot of retirees on fixed incomes, it matters. So Susan files her return. She sees the lower tax bill. And like a lot of people watching this channel, she starts wondering, if this lowered my taxable income, did it also lower the income number Medicare uses to decide my premium? That question is where this video actually begins. Here's the sentence I need you to remember more than any other sentence in this entire video. Medicare doesn't look at your taxable income. It looks at something called MAGI, Modified Adjusted Gross Income. And those are not the same number. They're not even close to being calculated the same way. Let's separate the three things that are getting tangled together in people's heads, because once you separate them, the whole picture clicks into place. Thing number one, your adjusted gross income, or AGI. This is your income from wages, retirement withdrawals, interest, dividends, capital gains, added up with a few specific adjustments subtracted, like contributions to a traditional IRA or certain retirement accounts. Thing number two, your taxable income. This is your AGI minus your deductions, your standard deduction, the extra deduction for being over 65, and now this new senior bonus deduction. This is the number your tax bracket actually gets applied to. This is the number that determines your tax bill. Thing number three, your MAGI, Modified Adjusted Gross Income. And here's the critical part. MAGI is built directly off your AGI, not your taxable income. Your AGI plus a few specific items added back in, like tax-exempt municipal bond interest. Do you see the gap forming already? Deductions, including this brand new senior bonus deduction, are subtracted after AGI is calculated on the way to taxable income. They live below AGI on the tax form, not above it, which means they never touch MAGI at all. MAGI is frozen in place before the deduction ever enters the picture. So when Susan's tax software calculated her return, here's what actually happened, step by step. Her AGI stayed at $90,000, full stop. That number didn't move. Then, separately, her $5,100 senior deduction was subtracted to get her taxable income down. That's the number that shrunk her tax bill. But the $90,000, untouched, locked in, that's the number that gets reported and stored. And that's the number Medicare is going to come looking for, not the smaller one. Now let's talk about why Medicare even needs a separate number, because this is the part most people never had explained to them in the first place. Medicare Part B and Part D have a surcharge system called IRMAA, Income-Related Monthly Adjustment Amount. If your income is above certain thresholds, you pay more than the standard premium, sometimes a lot more. And the income Medicare uses to decide this isn't your current year taxable income. It's your MAGI from 2 years earlier. So your 2025 tax return, the one Susan just filed, determines her Medicare premiums in 2027, not this year, 2 years from now. And I want you to actually see what these brackets look like, because it makes the stakes real instead of abstract. For a single filer, once your MAGI crosses roughly $106,000, you move into the first IRMAA tier, and your Part B premium jumps above the standard amount. Cross the next threshold and it jumps again, and again all the way up through 5 separate tiers, until someone at the very top income bracket is paying multiple times the standard Part B premium every single month, plus a separate surcharge on their Part D prescription drug coverage. These thresholds get adjusted slightly most years for inflation, so I won't hand you exact numbers and pretend they'll still be accurate next year. But the structure itself is what matters here. It's a staircase, and where you land on that staircase is decided by MAGI, not by how clever your deductions work. Here's what makes this genuinely frustrating for people, and I don't want to gloss over it. These aren't small, gradual increases. IRMAA is what's called a cliff structure. If your MAGI is $1 under a threshold, you pay the lower tier. $1 over, and you're paying the full surcharge for that entire next tier, not just on the dollar that pushed you over, but on your whole premium. That's a genuinely different design than how income tax brackets work, where only the income above a line gets taxed at the higher rate. IRMAA doesn't work that way. Cross the line even by $1, and the whole bracket applies, which is exactly why people go looking for anything that might pull their number back under that line, and exactly why a deduction that doesn't touch MAGI at all can feel like such a letdown once you understand it clearly. That 2-year lag exists because the IRS needs time to process returns and share the relevant data with the Social Security Administration, which is the agency that actually sets your IRMAA bracket. But that lag is also exactly why so many people get blindsided. You make a decision today, sell some stock, take a big IRA withdrawal, whatever it is, and the consequence doesn't show up on your Medicare bill until 2 years later, when you've completely forgotten you made that decision in the first place. So here's Susan's actual outcome, laid all the way out. In 2027, when the Social Security Administration looks back at her 2025 return to set her Medicare premium, what number do they pull? $90,000, her AGI. Not her taxable income after the senior deduction. Not $84,900, $90,000. The exact same number it would have been if the senior bonus deduction didn't exist for her at all. Let that sink in for a second. Susan did everything right. She claimed a deduction she was legally entitled to. She lowered her tax bill by a meaningful amount, and her Medicare premium, 2 years from now, will be exactly the same as it would have been without any of it. That's not a mistake on her part. That's just how these two systems were built, completely separately, using two different definitions of income that happen to share a lot of the same underlying numbers, but diverge at exactly the point where deductions get applied. And I want to be really direct about something here, because I think it matters. This isn't a loophole that got closed, and it isn't the government taking something back with one hand after giving it with the other. It's simpler than that, and honestly a little more mundane. The senior deduction was written into the tax code as a below-the-line deduction. IRMAA was written into the Medicare statute using an above-the-line income measure. Two different pieces of law, written at different times for different purposes, that were never designed to talk to each other. Nobody sat down and decided that seniors shouldn't get relief on both fronts. The mechanics just don't overlap. That's it. I think it's worth pausing here to talk about why this particular deduction gets so much attention when this same disconnect has always existed. For years, the standard deduction and the extra deduction for being over 65 already worked exactly this same way, below the line. No effect on MAGI, no effect on IRMAA. Nobody made videos about it because nobody was paying close attention to it. But $6,000 is a big headline-grabbing number. It got attached to a lot of coverage when the law passed. And when something gets that much attention, people naturally start assuming it must be powerful enough to move every number connected to their income. It's not a bad instinct. It's just applied to the wrong target here. There's also a version of this confusion that goes even one layer deeper. And I want to clear it up while we're here, because I've seen it in the comments on my last 2 videos. Some of you pointed out, correctly, that the senior bonus deduction itself has its own MAGI-based phase-out, the one we calculated for Susan earlier. So if MAGI determines whether you get the deduction, doesn't that prove MAGI and the deduction are connected? They are connected, but only in one direction. Your MAGI decides how big your deduction is allowed to be. The deduction, once calculated, does not flow back and change your MAGI. Income determines the deduction. The deduction does not determine income. It's a one-way street. And that's the exact detail that trips people up. Now that you understand why this happens, I want to give you 4 rules, not tax tips pulled out of thin air. 4 things that, once you internalize them, will keep you from making this same mistake with any future tax law, not just this one. Rule 1. Never assume a deduction and an income threshold are talking about the same number. Every time you hear about an income cutoff, for Medicare, for Social Security taxation, for capital gains brackets, for anything, your first question should be, what specific income figure are they using? AGI? MAGI? Taxable income? Because the answer changes everything. This one habit alone will save you from more retirement planning mistakes than almost anything else I could teach you. Rule 2. Remember the 2-year lag. Whatever your MAGI is this year is what determines your Medicare premium 2 years from now. That means the decisions that actually move your future Medicare bill are decisions you're making today, quietly, without any immediate feedback. A big Roth conversion this year, a large capital gain from selling a rental property, an unusually big required minimum distribution. All of that shows up on your Medicare bill in 2028, not 2026. Plan with that lag in mind, not against it. Rule 3. Know what actually does reduce MAGI, because some things genuinely do. This is important because I don't want you walking away from this video thinking there's nothing you can do. Contributions to a traditional 401k or a deductible IRA, those happen before AGI is calculated, so they do lower MAGI. Contributions to a health savings account, if you're still eligible, do the same thing. Structuring withdrawals from a Roth IRA instead of a traditional IRA, since qualified Roth withdrawals don't count toward MAGI at all, that's a real lever. The senior bonus deduction isn't one of these levers, but these other tools are, and if lowering your future IRMAA bracket is actually your goal, these are where your attention needs to go. Rule 4. Use the appeal process if your income was a one-time event. If your MAGI 2 years ago was inflated by something that isn't part of your ongoing income, you sold a house, you had a one-time large withdrawal, you retired mid-year and your income dropped afterward. Medicare has a process for that. It's called a life-changing event appeal, and it lets you ask the Social Security Administration to use a more current income estimate instead of the 2-year-old number. It won't help Susan's situation because her $90,000 is her regular ongoing income. But if your circumstances genuinely change, this is worth knowing exists. Let me walk through what a life-changing event actually covers, because the Social Security Administration doesn't accept just any explanation. The qualifying events include marriage, divorce, death of a spouse, work stoppage or reduction, meaning you retired or cut back your hours, loss of income-producing property due to a disaster, a pension plan being reorganized or terminated, and an employer settlement payment. Notice what's missing from that list. Selling a stock for a large gain isn't on it. Taking a bigger IRA withdrawal than usual isn't on it either. Those situations raise your MAGI, and there's no appeal path for them, which is exactly why Rule 3 matters so much. The tools that actually help you are the ones you use before the income shows up on a return, not after. I also want to mention a 5th thing here, even though I promised you 4 rules, because I think it deserves its own space rather than being squeezed into the list. Talk to a tax professional before you assume you even fall into an IRMAA bracket at all. A huge percentage of retirees never come close to these thresholds in the first place. If your income is well under $100,000 as a single filer, or under $200,000 as a married couple, this entire conversation may be somewhat academic for you, interesting to understand, but not something that's actually going to affect your premium anytime soon. Don't let a video like this one make you anxious about a bracket you were never going to be anywhere near. Know your actual numbers before you worry about the mechanics. Part 4. What this actually means for you. So let's bring this back to you, sitting there watching this video, trying to figure out what any of this means for your own retirement. First, don't let this discourage you from claiming the senior bonus deduction if you qualify for it. It's real money. It lowers your tax bill. Take it. The mistake isn't claiming the deduction. The mistake is assuming it does a second job it was never built to do. Second, if you're genuinely worried about hitting an IRMAA surcharge threshold, don't look at your deductions to solve that problem. Look upstream, at your AGI itself, and specifically at the 2 years before the year that matters. That's where pre-tax retirement contributions, HSA contributions, and the timing of large withdrawals or Roth conversions actually make a difference. Those are the levers connected to the machine that actually calculates your Medicare premium. Third, and this is the one I really want you to sit with, the 2-year lag means your Medicare premium in any given year is a snapshot of a decision you already made and probably forgot about, which means the best time to think about your future Medicare premium isn't when the bill shows up. It's right now, 2 years before it exists, while you still have the ability to shape the number that's quietly being locked in. Let's also talk briefly about Part D, because most people only think about IRMAA in terms of Part B, and that's only half the picture. If you're enrolled in a Medicare Part D prescription drug plan, or a Medicare Advantage plan that includes drug coverage, the exact same MAGI number determines whether you pay an extra monthly surcharge on top of your regular plan premium. That surcharge gets added directly onto whatever you're already paying your insurer. It doesn't go to Medicare directly, but Medicare is still the one deciding whether you owe it, using the same 2-year-old MAGI figure. So everything we've walked through today about Part B applies just as directly to your drug coverage. The senior deduction doesn't move that number either. One more piece I want to leave you with because I think it's the most actionable idea in this entire video. If you're a few years out from Medicare, or you're already on it but haven't hit an IRMAA bracket yet, this is the ideal moment to build what's sometimes called a MAGI budget. Before you take a large withdrawal, before you do a Roth conversion, before you sell an asset with a big gain, run the math first. Ask what your MAGI will be for that specific tax year, and ask what it will trigger 2 years later. A lot of retirees do this instinctively for their tax bracket, but forget that the exact same planning applies to Medicare, just on a 2-year delay. Building that habit now is worth far more than any single deduction, because it applies every year, not just for the 4 years this particular senior bonus is scheduled to exist. I want to go back to Susan one more time because I think her situation is actually a hopeful one once you look at it the right way. She's not worse off. She's exactly where she would have been on the Medicare side, and genuinely better off on the tax side. The only thing that changed is her expectations, and now that they're accurate, she can actually plan around the real number instead of a number she assumed existed. It's worth remembering, too, that this deduction is scheduled to disappear after the 2028 tax year, unless lawmakers extend it. So the window to actually benefit from it, while also being clear-eyed about what it does and doesn't touch, is a limited one. Use it while it's available. Just use it with accurate expectations about which parts of your financial life it actually reaches, and which parts, like your future Medicare premium, it was simply never built to touch. That's really what this whole video has been about. Not a loophole, not a flaw, not something to be angry about. Just 2 systems built at different times, using 2 different definitions of the same word, income, and the quiet cost of not knowing which definition applies to you. Let's bring it all together. The senior bonus deduction is real, it's valuable, and if you're 65 or older, you should absolutely look into whether you qualify. But it reduces your taxable income, not your MAGI, and Medicare's IRMAA surcharges are based on MAGI from 2 years ago, a number this deduction never touches. If lowering your future Medicare premium is actually the goal, the tools that work are pre-tax retirement contributions, HSA contributions, thoughtful withdrawal sequencing, and knowing when a life-changing event appeal actually applies to you. Money moves through more separate channels than most of us were ever taught. The people who retire with the fewest surprises aren't the ones with the most money. They're the ones who took the time to understand which numbers actually talk to each other and which ones only look like they do. If this helped clear something up for you, or if you caught yourself making the same assumptions Susan did, let me know in the comments. I read every one of them. And remember, nothing in this video is personalized tax or financial advice. Talk to a qualified professional about your specific numbers before making any decisions. I'll see you over there.